All right. Welcome, everybody. Weekend update. I wanted to call it a weekend update.
Sure.
Like
Why
Saturday
not?
Night Live. Yeah. Like, what does this call it? We've only done about 50 of these or more. Weekly roundup. Scott and Ben. I'm pretty
Yes.
sure that's Ben and I'm Scott. I'm not sure.
Yes.
I don't know. Rough start already. All right.
Yes.
Interesting week in the market, wasn't it?
Yes. Yes. It was.
Yeah.
Lot,
What was
lots going on.
interesting?
Everything continues to be interesting. There's lots of obviously market activity is what I think has driven a lot of the attention. Certainly some big misses and some big beats in the tech space. And you're seeing a lot of action where Facebook obviously missed on, I think that was yesterday, Thursday. So they missed their earnings, probably one of their worst quarters ever, as they pivot to the metaverse, and they lost 200 billion of market cap, which is the biggest ever single day loss of market cap in history of the markets. And we had Amazon today report good numbers. At least they appear good numbers on the surface. So their stock was up 13% today, similar, biggest ever single day market cap increase in history by a company. If you look through the numbers from Amazon, though, the data wasn't great. Like, they made most of their money from cloud. The actual retail buying was soft. So that was today. We had jobs numbers as well today, both in Canada and the US. Made a couple 100,000 job losses in Canada in January, driven, they say, by the Omicron virus. And US had a big beat, 460 plus thousand jobs. And why any of this is relevant is that when you have a big jobs beat, what that will likely do is continue to put increased pressure on the central bank to raise rates in the US. In Canada, I think I'll look through it, but there's a potential argument to be made today. Canada had a bad jobs number. Canadian dollar went down a lot versus US dollar. US dollar is up 65 basis points, I think, today, which is a pretty big move.
Yep.
So, those are some of the macro / corporate headlines, and then below the surface, there's a ton of things going on with volatility and options and short covering and things like that as well. So, tons going on, lots.
Lots going on. So did lots go on in the portfolios in that environment?
Yeah, so we got a pretty nice bounce off of the lows in January. So we saw the Nasdaq kind of rally about 10%, and the S&P rally about 6 or 7. So I took that opportunity to make changes into that, and so I think completely removed any exposure to SPY directly. Still own some equity exposure, of course, but directly reduced SPY. And also that's mostly in Canada and the US, so SPY and XSP in Canada. And as well, anything XLK or QQQ, took advantage of making some changes if there was any residual positions there. Subsequently, one other change yesterday, I believe, is I did add to the NASDAQ puts that I bought. I bought the first tranche about a week and a half ago, maybe 2 weeks ago now. And so added to that position coming into the rally on Wednesday with NASDAQ. And so, NASDAQ's up a bit today as well. But, looking at what has happened today, yeah, I'd say it was a pretty good day to add to bonds. So I did add a little bit to TLT. I had bought Snap in clients' accounts in December, a little bit too early. Snap was up 60% here today. So they had good earnings, first quarterly profit ever. Looks like massive short covering. So I switched out of Snap into long bonds.
That's a lot. You did a
Yeah.
lot this week.
Yeah. You know, as I think I've tried to put into the dailies there, occasionally the markets give you an opportunity to reposition. I believe this week really has, and this, let's say last week and a half, it's really given you a chance. If you weren't comfortable with the risk setup you had at the start of January, there's an opportune time to reposition for it. So yeah, I'd say I'm happy that we've got this bounce so you can reduce exposure and better hedge. And I'm feeling much more comfortable from a positioning perspective now than I did 2 weeks ago.
Right.
Yeah.
Awesome. So that being said, what do we got in Ben's charts this week?
Got a few things, some job stuff, a little bit of Russia, and some debt. So you want to jump through that?
Yeah, definitely.
Okay.
As usual, if anybody has any questions, feel free to ask. I think we did have one from Eric in email a couple days ago, so I'll come back to that. And I think,
Yeah, I think he was
also
asking
some
about
info on gold.
Okay. All right. Yeah, I think Eric asked about yield curves, so we can talk about that.
Yes.
Yeah, and we can touch on gold again as well. But yeah, this is the first chart. This is kind of jobs, non-farm payrolls. It's a mouthful. So that came out today with a big beat. I think initially the market takes it potentially as a positive, or at least that's what the CNBCers are saying. I think that it really cements the fact that they're going to raise rates, even though the economy is slowing. And so the thing with a lot of this economic data, at least the stuff that comes out on these big days, is it's always backwards looking, right? And so you can't make decisions on backwards looking data, so to speak. So this is just a quick look at, what's the non-farm payrolls here with a beat. And so what does this look like? Well, looks like what they're planning to do with rate increases this year. And so we're talking about the March 16th meeting, which everyone seems to think is the live meeting, so to speak, when they're going to do something with rates. So, we're looking at 75% or 75 basis point raise by June, or at least this is what it's saying, and continued further rate hikes into 2023. And if you look actually a little bit further out, which is strange now and doesn't seem to grab headline attention, 2020, back half of 2023, they're talking about cutting rates already, on at least in the yield curve. So that's an odd setup, which typically is worth paying attention to because it means the economy be slowing. But right now, this is what everyone's paying attention to. Rates are going higher, and I think they're wrong, but this is what the market's giving you, and I think that's where the opportunities lie. Is that if they don't raise rates like this, then bonds obviously rally significantly off of one of the worst years for bonds in history. So this is Russia. So it's a little bit of geographic discussion today on Friday afternoon, but everyone's talking about why the heck does everyone care about Russia and the Ukraine? And so I think one of the more important things is to realize, that I'm sure you're aware that Russia is the biggest country by geography, and Canada is the second biggest by geography. But everybody lives, at least in Canada, within a few miles of the U.S. border. Similar in Russia, everybody lives within a few miles of the European border, or at least the majority of them anyways. And so why it's such a big deal, what's happening there, it's the massive population that's really tucked in right next to Ukraine, and they play a major role in how Russia has access to Europe. And so that's why it's so important. That's why everyone's freaking out about it, alongside many other human rights issues, but that's why kind of that attention is here. And then if we look at kind of wheat production in the world, so these commodities things, Russia is responsible for about 17% of global wheat production, and so that's all again right tucked into the European borders here. And so it's a bigger thing than maybe it might look like on the surface, and something we need to continue to pay attention to as a potential outlier.
Got it. Interesting. Interesting. That's a good
Russia,
one.
Russia,
A
a
little
little Russia.
geography on a Friday.
I love geography. Get an
Yeah,
A in
me
that
too.
one. And then the state of the world's debt. So not that anybody cares about it, but part of why I keep harping on the fact that I don't think rates can rise. This is a major piece as to why I don't think rates can rise. This is the GDP, this is GDP to debt to GDP ratio for all the major countries in the world. Obviously, we see Japan smack dab in the middle here at 257% of debt to GDP right now. And then if we look out, Greece is actually in better shape than they are, Sudan there, and then we get into some of the other smaller countries. But if we go out to the next ring, this is where I see the US and Canada. US 133% of debt to GDP, where Canada's at 110. So this is a major reason why I think rates can't go higher, because the central banks of the world are the ones carrying a big line share of the global debt in the world. So, they issue the bonds. If you're the one carrying all the debt, and then your costs are going up, it's going to be a real big challenge for GDP to accelerate substantially from here. So, tighter rates, higher rates and tighter monetary policies not healthy for GDP. So this is one of the more interesting charts I've seen from a debt perspective in the last little while.
Definitely.
Yeah.
Yeah, very, very interesting. That's 3 charts today that everybody I think could read and understand. That's pretty good, Ben.
Yeah. Trying to keep it simple here.
Hey, keeping it simple for us today. It's good. I like it. Okay, cool. Good. Here we go. Any questions yet? Why don't we touch on that one for Eric about
Yield curve.
Yield curve, yeah.
Yeah.
I think he just wanted to know what it was, like in layman's terms, is what he said.
Yeah, so the yield curve is basically the central bank's overnight rates, where we are right now. Start at, say 25 basis points, and as you move further out the curve, the steepness of the curve typically indicates where you are in the cycle of the economy. And so if you get a natural curve, kind of bottom left corner to top right corner, that typically signifies a healthy economy, where banks lend on the short end, or banks borrow on the short end at say 50 basis points, and they lend on the long end at 2 or 3%. That's a natural progression. That's healthy economy, healthy banking system, etc. And so what we've seen right now is we've seen all this expectation that rates are going to rise. So the front end has gone from, we'll say kind of 0 till about 50 basis points in Canada and the US on the short end, up to kind of 70 to 1% on 1 years. The 2-year now in Canada is 1.36, and the 10-year in Canada is 1.85. And so the difference between those two are one of the more important metrics, I guess, to look at when you're following the economy. And so they talk a lot about these 2s, 10s. And so if that 2-year rate is above the 10-year rate, that, as I've said before, 100% historically has signified a recession is coming when you get an inversion. Typically there's a lag, but obviously things change. So that kind of the convexity of that curve is really important. And as we pay attention to it right now, a lot of people I talk to seem to think it's not a serious deal, but the 5-year and the 10-year now is only 10 basis points of spread. That's super narrow, and a super flat curve. So typically signifying that something bad is coming, or at least that's what the bond market's telling you. So the bond market might be wrong, but historically the bond market has led equity markets. So that's why it's important to pay attention to.
Explanation.
Was it simple?
And then Lyle sent us a outlook for gold.
Mm-hmm.
I bring that up because we did have a few questions about gold lately. So what's the macro outlook for gold in a quad 4?
Yeah, so it tends to be a good asset class to own, at least on a back test. It's historically been a good asset class to own in a quad 4. And then when you look at the range within how it trades right now, the bottom end of the range is around 780 on GLD, which is the gold ETF, or sorry, is where you would trade. So it's at the bottom end of that range is there. And, the top end is kind of 1850 right now. Why that's relevant is we continue to see that marching up, where the bottom end is coming up and the top end is going higher. And so quad 4 says good for gold. Technicals say also positive. So I would continue to lean along. It's a good place to own and have some exposure to at the immediate point right now.
Great.
Hmm.
All right, and what do we have coming up what are you looking ahead to for next week?
Yeah, so after the day like this, we did feel like, at least from a market perspective, that there was a lot of short covering happening. And so if there's a possible follow through and higher prices after today, that will make me say maybe something's a little bit different. But at least coming into the close today, as I've mentioned, we added to bonds into this. We sold and reduced risk into this. So I'd be looking for what the action's like, at least on Monday or Tuesday. And that would be a sign to say, has something changed, or are we still in the view that growth is slowing, inflation slowing? And as I've mentioned before, oil seems to be that kind of one commodity that hasn't cracked yet. And if you're looking at kind of what people are saying, at least below the surface, oil looks extremely overbought. It looks extremely vulnerable for a pullback. And so we'll see. If we see breakouts, it may change, but right now I continue on the view that nothing's different. The economy is slowing, inflation's slowing, and we'll continue to add with that view.
Great. Okay, anything else you wanted to talk about before we get out of here for the weekend?
So just the last thing, we're we're in kind of RSP season still. So if you haven't done that, certainly please let us know to take advantage of that. We are also doing TFSA contributions. And the last thing, which we did a flow through presentation last year for clients with Brent Larkin that discussed why you should think about flow throughs. This is the time of year when most of those launch. And if you remember what those are, the only place outside of an RSP where you can get 100% tax deduction. So, those kind of 3, I'd say, planning steps are something to look at. If you have questions on them or would like to do anything, certainly let Scott or I know on those.
Yep, exactly. Yeah, we've been doing a lot of those lately. So what's the deadline this year is March 1st, I think. So so I'll have a bit of time, but it's best to get them in early.
Yep, absolutely.
Okay, well, I think that's it. No more questions. Oh, we do have a question. We do. No question goes unturned. Lyle says best safety advice right now, don't go downtown Ottawa this weekend. That's probably a good, yeah. Us West Enders don't go downtown right now anyway. So
yeah, exactly. We don't go past Bank Street.
Oh, you know what? It would have been good to take the kids to the canal maybe, but that ain't happening.
Yep.
Yeah, exactly.
Perfect.
Okay, everybody, stay warm, stay safe, and we'll see you next week.
Thanks. Take care.